7:15 2011 time is 5:50 a.m. Pacific Standard Time. This is the gap open up on the Nasdaq comp. Today is the monthly options expiration MMTs, and what we have here on the super gap list is we have Google, we have Priceline, Baidu, Sina, Apple, Amazon, Netflix is finally getting its gap. That bull, that TQQQ, is up 2.45 ratio. So with the expiration coming to an end on the monthly today, there will be considerable price volatility. Okay. Not only that, we will be looking at the other side of this gap open. As you can see here, the gap open down list. You've got Fleur. They didn't have that great of an earnings, okay? But the gap open down is diminished. The price action volatility will remain at extremely high levels. Google has the biggest gap today, as the current gap is $68. And it's a nice trade. The Bellwether delivered wonderful numbers. We also are in that trade. And we'll monitor going forward on a shorter term basis. Is on the weekly chart, we'll be looking at Google as to where the upper end of this gap, so it starts at a gap of this magnitude here, then it will have its support and resistance levels, and there's been a slew of upgrades. Yesterday, as I said, during the options volatility, Wednesday and Thursday both were that Wednesday we had a super gap. They sold the calls. Yesterday, when stocks finally put up their upper end of their trading ranges now, when they finally get that intraday high in, they were exiting the call side of the market, but then flipping right back over and buying that put side of the market, because the put side of the market is the most deflated side of the market right now. And the calls still remain at high levels from the original. Today will be a total of a 3-week price action pattern from when we called the very bottom of these markets. We ran up, and like any bull, short-term bull trend, you have to have a pullback. But we're not nearly as overbought as we were at the end of last week at this time, where the indexes went from extremely oversold in a 10-day period to extremely overbought. And that's what volatility is about. There's upside volatility and downside volatility. When these related names today, once again, it'll be the very same case, is that as they do make their highs, the weakness came yesterday morning very quickly. Instead of consolidating those highs for a period of time like they did on Wednesday, and it was the last hour and a half of the market on Wednesday when they came down. Okay? Because they did. All right? So basically, that trade management today is going to be that during the expiration, as they're selling out the call side of the market, when these gap up, the calls gap up in value and the puts will gap down in value. That's the put side of the market. And price, we have what we call price imbalances. So when you look at a put to call ratio in a very short term or a daily term or a longer term relative to where the indexes are, but individual names, is that the call side gets totally deflated mathematically, and the call side mathematically is inflated, and that's what we call a put to call ratio imbalances there. So as stocks go up and hit their higher levels today, you'll see a lot of volatility that will run them up there. The key is when that distribution bar, that's called a sell bar next to the green bar, on the opening bell, it hits it, comes down 369.12 or 369, pops back up. And the key, as I said yesterday, was that it's a lower high than the previous intraday high reversal in volatility. So you come up, but then you got that red bar right next to that green bar, that distribution bar. And what we will do once again is that once those highs are in, they build a weakness. The stock starts to get what we call a price action reversal, start to build weakness, and therefore the shorts start to work. We will tell by the application that we have. That will tell us how strong they are, and as they start to weaken, we will see that price volatility to the downside come in, just as the gap open volatility is here. So the trade management will remain the same as it was yesterday and as it was on Wednesday. Monday and Tuesday during the options expiration, we know that the calls were inflated on day one of this monthly expiration, and that equities had come down, and then Ben Bernanke had came in, and we got that rally on that Wednesday during those hearings. But then it appears that he had a lot of stuff to say about QE3 not being on the table, but it's all rhetoric that causes price action volatility. So a lot of these gaps today are in sympathy. We call sympathy gaps, and because of the Google, the price lines, the Baidu's, and the internet stocks and whatnot are gapping up in sympathy with this great earnings report on Google. Trade management remains the same.